Income protection is sometimes mixed up with payment protection insurance, or PPI, and we've all heard of the PPI mis-selling scandal. What essentially happened was PPI was being added to loans and credit cards with the lender, sometimes hinting that the finance approval itself actually hinged on you taking the insurance out. Many of the companies at the time targeted their employees and how many they sold, rather than whether or not it was actually suitable for the people that they sold it to. So it really came as no surprise when the FCA, or the regulator at the time, took a blanket approach along with the Financial Services Compensation Scheme and FOSS, the Financial Ombudsman, in order to actually repay many of the clients that may have been missold for PPI at the time. Income protection, on the other hand, is a fully advised product, generally set up by a qualified advisor, someone who can take into account your own individual situation and assess it and recommend whether or not a policy would be suitable for you as an individual in the event of you being unable to work through accident or sickness. In general, income protection can protect up to around about 60 to 65% of the value of your gross income, which is your income before tax. So for example, if you earn £24,000 a year, you would maybe be able to protect around about £1,300 per month. Now that's tax free, and you can choose to have that £1,300 per month paid until you die, until you retire, or until you return to work, depending on how you set your policy up. Also, that £1,300 per month is to use for whatever you want. So it could pay your mortgage, it could pay your rent, your council tax, food, bills, gas, electricity, whatever you want. It is your money to use as you see fit. The insurance would kick in after your employer stops paying you. This is called a deferred period. So essentially, if you're paid for 6 months full, your employer then would stop paying you after 6 months and your insurance would start. Likewise for a month. The longer the deferred period, the cheaper the policy is itself. So if you have savings, for example, but you're paid only for a month and the savings would last you for anything up to 2 months beyond that month, you could potentially look at a 3 months deferred period, which would actually be a good way to manage your costs, because it would reduce the insurance premiums for you on a monthly basis. So why is this suitable for everyone? Well, as all personal insurance goes, it gets more expensive the older that you actually get. And that's the same regardless of whether it's life insurance, critical illness cover, or income protection. So the younger that you are, the cheaper the policy itself, all things being considered as equal. So let's say you're 30 years old on a salary of £24,000, as we used in a previous example. This means that you could potentially claim your £1,300 per month every single month up until your state retirement age of 68 years of age, which is the age you would be expected to work until if you were 30 years old as of today. Now, even without any indexation or any inflation proofing on the income, that would be close to £600,000 in total that you would receive should you actually claim for the full term of the policy itself. Now, most people will tell you that their house is the biggest asset. It's very clear very quickly, and in most people's cases it's your actual income that is your biggest assets. And most people will actually earn over £1 million in their working life. If you have a look at the graph, you can see the blue line represents earnings from age 30 to 68 with no increase for inflation or pay rises. This is before tax, so you would be needing to pay tax on that. The orange line itself represents the benefit that you would receive here at £1,300 per month, which is the benefit that would be paid completely tax-free to yourself. Let's look at the other end of the spectrum, the working spectrum, and let's say that you're 57 years old and again unable to work through accident or sickness. Let's say your employer pays you for 3 months. After the 3 months, then what are your options? What are you going to do? Well, the natural thing would be to rely on savings. So you can ask yourself the question, how long would they actually last for? As part of our planning process, we normally recommend 3 to 6 months worth of savings put away as an emergency fund to start off with. Or if you're lucky enough to have a pension, you could potentially access that early. However, that's really going to mess with all the planning that you've done to retire at your projected age, and more importantly on the income that you desire to retire on. What happens if you can't return to work at all? So having to retire 10 years earlier What's that going to do to the value of your retirement fund itself? Essentially, does that mean then that you're going to run out of money even before you reach retirement age? So £100,000 as a pot may only last 10, 11 and a half years at £10,000 per year. And by the time you get to state retirement age, you may then be only able to survive on the state pension, which is currently just over £9,100. And ask yourself the question, is that something that you would be happy or comfortable with? So income protection is not just for the younger or the older generation, it's for anyone in receipt of an income, whether it's employed or self-employed, and they should consider it as a priority. What is the most likely thing to happen to you before you retire? A, would it be to die? B, become critically ill? C, become unable to work through accident or sickness for any period of time? Then ask yourself obviously what the order of priority should be in order for you to protect against these things. If you consider the likelihood of premature death is relatively low before you retire, but the impact is massive, most people will have some form of life insurance for that. Critical illness cover is maybe 4 to 5 times more likely to happen than death before retirement. Again, impact is massive. Income protection or being unable to work through accident or sickness, bearing in mind all really critical illness covers would normally be covered within that, as well as less serious illnesses and as well as accidents. The likelihood of that happening is higher, and obviously the impact is large as well. Legal & General released some stats recently around the average length of claim that their policies were being paid out for under income protection, and it was just short of 5 years, and this was pre-COVID. So that's the kind of harsh reality of it. If you were lucky enough not to lose your job during COVID, but for example had your income reduced down to the 80% that was offered by the furlough scheme, what kind of difference did that make to you and your lifestyle itself? When you then consider that in the event of being unable to work through accident or sickness, the government help that you'll get is just over £95 per week, about £410 roughly per month as of September 2020. It gives you a kind of understanding of what level of income you would need to survive on should you not be able to work for a longer period of time. So income protection isn't free, you do need to pay for it. It's an insurance policy, and like any other insurance policy, you hope you're wasting your money on it. The question you need to really ask yourself is, would you rather pay for something that you might not need rather than need something that you're not actually paying for and therefore you don't actually have? As always, if there's any questions that you would like to have on this, or ask me anything, or have a discussion around this, please reach out and I'd be delighted to speak to you about it. In the meantime, please stay safe and I'll speak to you soon. Thank you.